Hey everyone, well here it is. I have finally produced it, my long-awaited video on what is, in my opinion, the most important, the most reliable predictor of recession and market collapses in the history of the stock market. Let's jump in. I'm Joe Macek, portfolio manager and investment advisor with IA Private Wealth, and welcome to my YouTube channel, Investing Made Simple, where you can always find the most trusted information on how to build your net worth using all types of investments fast. I have been meaning to produce this video for a long time, as the yield curve and its shape is one of the most important things I look at when making my forecasts on the market. But as always, before we get too deep into this video, I'd like to go through my usual disclaimer. And the long and the short of it is, before you make any decisions surrounding your money based on any video you see on YouTube, please take the time to consult with a fully licensed professional, or feel free to reach out to me on a one-on-one basis. The other thing I would be absolutely thrilled beyond measure if you did it would be to smash that like button for the YouTube algorithm, as it really helps out my channel. Hit that subscribe button, leave a positive comment below in the comments section, and darken that notification bell so you can be notified when I upload such award-winning epic thrillers as How to Train Your Kids to Be Rich and Here Are My Top 10 Investment Laws That Every Investor Should Follow. That's right, epic thrillers. And now, without further ado, we dive deep into the undisputed heavyweight champion indicator of the world, the yield curve. It is, in my humble opinion, the most valuable indicator to learn about and to be paying attention to. And without trying to be even more dramatic than I have been already, I want to try to describe to you just how good this indicator is. Because as far as indicators go, this, in my humble opinion, is the Serena Williams. It's the Michael Jordan. It's the Florence Griffith Joyner. Heck, it's the Tiger Woods on Sunday of indicators. Yes, this indicator is that good. It is head and shoulders above any other indicator that I use. And it's not even an indicator from the stock market. It's an indicator from the bond market.
Did you say bond market?
Yep, that's right. If you want to learn what's happening in the stock market, the best indicator is actually in the bond market. So what is this yield curve? What does it do? Most importantly, can we use this amazing indicator to help preserve our net worth? Well, the yield curve, simply put, is a graph or a chart that displays all of the treasury yields of a given country over time and connects them all together. What it does is, when the yield curve displays a certain type of shape, it can, with remarkable accuracy, forecast recessions, and with those recessions, typically market collapses occur. Depending on what stage of saving and retirement you are in, this indicator could mean the difference between a retirement in comfort and having to go back to work, as you might be able to use this indicator to preserve your capital at a particularly vulnerable time close to your retirement. In this video, we will be focusing specifically on the US yield curve, because quite frankly, most of the world's investable assets by market capitalization are in the US. Canada represents less than 4% of the world's market capitalization, where the US routinely is around the 50% mark. In fact, Canada represents such a small amount that if Canada were removed for any reason, I'm not even sure anyone would know we were gone, let alone look for us. So if you've ever wondered why in all of my market commentaries I tend to heavily focus on the US Federal Reserve, the US consumer, and a number of US analytics, even though I am Canadian, this is why. Just how big a deal is the US market? Well, it's such a big deal that when it goes into recession, it not only affects Canada and typically drags it into recession, but it also affects the entire global financial system and affects many other countries as well. There's an old saying amongst advisors and portfolio managers that is very well known, and it goes something like this: when America sneezes, the whole world catches a cold. It basically means that if something bad happens to the US market, the Canadian one and most other ones in the world usually follow suit, not the other way around. So for this video, and for all future videos, unless something huge in the world changes, I particularly focus on the information from the largest, most liquid market in the entire world, the United States. And now back to our graph. On the vertical axis, you have interest rate levels, and on the horizontal axis, you have the length of time for maturity. In this particular graph, we will take all of our maturities from the 3-month treasuries right up to the 30-year treasuries and put them on the horizontal axis here. On the vertical axis, we will insert our interest rates going from 0 up to about 7 to 8%. And in this example, we are going to use a time where the yield curve was normal, so we can illustrate what the yield curve looks like most of the time. And we're going to give a big shout out to stockcharts.com, as this is my go-to graph for yield curve views. There is a link in the description below, and the website is completely free. It is so cool, you can even animate the shape of the yield curve in real time and visually compare it to what the price action of the S&P 500 does, which is absolutely insane. Later on in this video, I will animate parts of the yield curve and provide some commentary throughout the animation so you can get a really good sense of how unbelievable this indicator is. So to help illustrate what a normal yield curve looks like, we took this snapshot of the yield curve on the 28th of July 2004, where the following maturities and lengths of time were as follows. The 3-month was at 1.46, the 2-year was at 2.78, the 5-year was at 3.82, the 7-year was at 4.23, the 10-year was at 4.61, the 20-year was at 5.35, and the 30-year was at 5.37. When we connect these maturities and yields together, we can see a distinct curve made up of the different yields across the maturities known as the yield curve. And the shape of this particular yield curve is what you will see most of the time. This shape is what is referred to as a normal shape or a normal yield curve. It is when shorter maturities have lower yields than longer maturities. And if you really think about it, it makes complete sense. You would expect that the longer you tie up your money in a fixed income instrument, the more of an interest rate you should be paid. The normal shape of the yield curve is one of 3 main shapes the yield curve takes on. In addition to this shape, there are flat yield curves where near-term maturity yields are roughly equivalent to longer-term yields. And finally, we have the inverted yield curve where short-term rates on the short maturities exceed longer maturity yields. Flat and inverted yield curves occur when the short end of the curve increases further and faster than the long end of the curve. And over the past 3-4 months, that is exactly what has been happening, which is why the media has been drawing so much attention to it. The shape of an inverted yield curve is the curve that makes no sense. After all, why would you tie up your money for a long time, say 10 years, at a rate lower than what you could get for a shorter maturity, say 3 months, with a higher interest rate? This is the telltale sign that something is happening in the bond market. The bond market is telling you something bad could happen in the stock market. And this shape of the curve is also the shape that gets the most attention from the media. You will see headlines such as, "It's official, the yield curve is triggered, does a recession loom on the horizon?" A recession warning sign, part of the US yield curve inverts for the first time since 2006. And 2-year treasury yield tops 10-year rate, a yield curve inversion that could signal a recession. And of course, as all news headlines try to do, they try to scare you into reading what they have to say so that they can sell more advertising. They make their headlines very ominous and sometimes piece together certain nuggets of information to make the information seem a lot scarier than it actually is. But typically, these headlines are often misleading. You see, they are correct in the fact that the 5-year and the 30-year did in fact invert for a brief period of time, and just recently the 2-year and the 10-year inverted as well. But these inversions were not the inversions that were studied when it came to being a predictor of recession. You see, the first person that recognized this phenomenon was Campbell Harvey, a Duke University finance professor, and dare I add, a fellow Canadian. Harvey wrote a dissertation in 1986, link in the description below if you really want to get into his original dissertation, that first showed the yield curve's extraordinary extraordinary ability to predict recessions, specifically the inversion of the 3-month yield versus the 10-year yield. At the time, his model had correctly predicted the previous 4 recessions, and it has gone on to successfully predict every recession since its publication. That's right, it's been right 100% of the time since 1968. And as you can see on the Fred website, link again in the description below, you can see this chart is a chart of the 10-year minus the 3-month yield, and every time the 3-month yield is higher than the 10-year, the value becomes negative, and when that happens, shortly after, you see the gray recession indicator after that. Harvey's model is 100% correct from 1968, but what's more impressive is the signal has not given any false signals since then, contrary to what you may read in the media. Any articles I found claiming these false signals, again, we're looking at the wrong maturities, such as this article here looking at the 2-year and the 10-year. In fact, most articles claiming the inversion is different this time, and there are tons by the way, use the 2-year and the 10-year as their model, which makes no sense because all of the research that was done by Campbell Harvey was done on the 3-month and the 10-year. Harvey's studies specifically focused on those 2 maturities, not the 5 and the 30, not the 2 and the 10, not anywhere else on the curve. The 3-month and the 10-year is what he focused on. So when you are reading doom and gloom articles, all you have to do is check what part of the curve they are talking about, and you can quickly dismiss what the reporter is saying if they are talking about anything other than the 3-month and the 10-year. And currently, as of April 2022, the 3-month and the 10-year are not inverted and not subsequently signaling a recession. This is the signal you should focus on if you are going to follow the yield curve as a predictor. But why? Why is the 3-month rate in relation to the 10-year rate so important on the curve? Well, it all has to do with the banking system being able to lend money, as lending is a primary fuel of an economy. You see, the core business of banking has always been to take the short-term deposits that people make at the bank and make money on it by loaning it out at higher rates as long-term loans. And the fatter the spread between these deposits and long-term rates, the more money the bank makes, and hence the more eager the banks are to loan that money. Lending money is highly expansionary. This gives everyone more money to open up a business, buy a house, and make other general purchases. As I said before, it's one of the main drivers of an economy, which leads to higher earnings and then typically higher stock prices. When the short-term rate is equal then or higher than the long-term rate, it becomes less profitable for the banks to lend money, and the banks are far less eager to do loans. In fact, the only real way the bank can make money when this happens is by charging an even higher rate to less credit-worthy borrowers, which increases their overall risks. And banks usually aren't too eager to do that. Less lending tends to starve the economy of expansionary fuel and typically leads to recession, lower earnings, and usually lower stock prices. Now, this is not to say that other inversions along the curve shouldn't be watched and can't be useful, but I would again stress one more time that the original report and Campbell Harvey's findings specifically is what you should probably use. Now, whenever the yield curve inverts, there seems to be, and I don't know why this is, but there seems to be a ton of very reputable leading market experts that completely dismiss the predictive power of the yield curve and start to come up with all sorts of reasons as to why this time it's different. In fact, one line seems to be repeated ad nausea every time we have an inversion. And this, I find, is quite hilarious. Bill Gross said it in 2007, Janet Yellen said it in 2019, and now we have a brand new market commentator that is also saying it today.
What I think is probably, more critical is really looking at why the yield curve is inverting and some of the peculiarities around this yield curve inversion versus prior periods. And I think there's reasons to believe that this time around, yield curve inversion may not be as good of an indicator as it has been in the past, particularly given the enormous amount of quantitative easing undertaken by global central banks.
For the record, Bill Gross was wrong in 2007, Janet Yellen was wrong in 2019, and anyone regurgitating this line today is very likely wrong as well. And that's not all. article after article after article are betting against the predictive power of this indicator over and over and over again. Why? This is my personal opinion, and I could be wrong, but I think in general, the thought of going through a bear market like 2000 to 2003, or an 08-09, or 2020 is so painful and so full of panic that these experts would rather create reasons and deliver different lines of reasoning because nobody wants to think about markets collapsing. It's an extremely painful thing to experience and endure. Betting against this indicator is not something I do, and I really don't think you should do it either. Okay, so now that you've educated yourself on what happens, the first thing that you're going to say to me, which is what most of my clients say, by the way, is, Joe, when are we going to cash? And it would seem that this would be a very logical move. I mean, if the yield curve inverts and it's very good at signaling recessions and subsequent collapses, any investor would think cash would be the asset to go to. After all, you can't lose money in cash, right? Technically no, but yeah, you can lose money while sitting in cash. And as always, it's not as simple as selling everything and waiting for the market's demise. You see, you never know when the markets are going to tumble. It could be a month, a year, even 2 years. And there is a chance, a small percentage of the time, that markets don't fall at all. They just continue to run as if nothing ever happened. So in theory, you could be sitting in cash a very, very long time waiting for the markets to collapse while the markets continue to roll higher. How long are you going to be patient sitting in cash while the markets are making new highs? My guess is not a long time. Now let's look at what happens to the markets when the predictor lets us know a recession is on the horizon. And I will be showing you the last 3 yield curve inversions, 2000, 2006, and 2019, and show you exactly what happened to the stock market soon after the yield curves inverted in a very powerful animation from our friends at stockcharts.com. Okay, so there are a few things you will notice with each inversion. Sometimes the market collapses can happen quite quickly, others take time to develop. There's typically a lag between the inversions and when the markets roll over. In 2000, it was just a few months, while in 2006, it took about 12 to 18 months for the markets to drop. Both times, peak to trough, the markets lost 56%, and the lag was about 12 months in 2019, and the markets collapsed in 2020 by about 43%. So clearly, in most cases, cash will not work. Okay, so now you're wondering, well, if cash doesn't work, is there any way to continue to make money in the markets while still getting massive downside protection? Now you're getting warm. And the short answer is yes. There are investments that allow you to earn a very reasonable rate of return, capture a lot of the upside while simultaneously minimizing your downside capture in the markets in the event of a collapse. What investments do this? Well, these investments are in my next video, of course. But here's a hint. It's not any of the safe havens that are commonly written about in the articles that you see out there. These investments are super cool, but you'll have to tune into my channel and see the next video that I will walk through what are, in my opinion, the best types of investment vehicles to use after the yield curve inverts. In closing, I really hope you've enjoyed this video, as it was a real fun one for me to do, and I'm a huge believer in the power of the inverted yield curve to predict recessions, and hopefully after this video you are too. Once again, I want to thank you for joining me here today at Investing Made Simple, where you can find trusted information on how to build your net worth using all types of investments fast. Please hit that like button for the YouTube algorithm, as it really helps out my channel. And if you like my content and you want to be kept in the loop with all of my latest videos, I would be thrilled if you would just hit that subscribe button, leave a comment below in the comments section, and darken that notification bell. Until next time, this is Joe Macek for Investing Made Simple. See you soon.